Are you confused as to whether to buy a stock or shares or not? In case you are confused, at the end of this video, you'll understand the signals you need to be looking at for you to decide if to buy a stock or shares. Because I'm going to discuss 10 buying signals which every investor out there need to know so as to be able to make informed decision when they are deciding to buy stock of any company out there in whichever stock market. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about investing and making money each and every day. In case those are kind of topics which you like, down there is a button called subscribe. Click the button for you to subscribe to my channel so that you don't miss any of the videos I upload each and every day. And while you're still at it, drop a like on this video. Thank you for subscribing and also liking this video. And by the way, guys, I also recently released an ebook about building portfolio and managing portfolio optimally. In case you want to buy it, the link is down below in the comment section and the description. Having said that, the very first signal you need to be looking at is if the stock is trading below its intrinsic value. Guys, what you typically see in the market is the market price of any stock or any share. Simply put, that is an entry signal for you, basically saying they are allowing you to get into ownership of a given company stock. But then again, the price you typically see in the market is driven by investor sentiments. Investors' sentiments do dictate the demand and supply of any stock or shares in the market. But the true value of any particular stock is anchored on very different fundamentals, which are basically anchored on the business performance. That is why you need to focus and see if the stock is trading below its intrinsic value. Because if it is, that is what we consider in the market as being undervalued. And the best buys for you is to buy an undervalued stock. And that is so because when you buy an undervalued stock, after some time, it's going to move towards its true or intrinsic value once the realities of the fundamentals of the business hit the market. And through that, you're going to see the stock price appreciate or increase. In case you do a mistake of buying an overvalued stock, chances are you'll end up suffering because after price correction, the price is going to drop to reflect its intrinsic value. So there are measures out there which are computed for you to be able to know if a stock is undervalued or not based on its intrinsic value. Case in point, the PE ratio, right? Just simple ratio, maybe even price to book value. Those are simple ratios which can assist you know if a stock is undervalued or not, and then decide to buy or not to buy, okay? And then the second signal, which is a good one, is that revenue of a given company is growing consistently. At the end of the day, revenue is going to dictate how stock of any company out there is going to perform. So if revenue is growing consistently, and I'm talking about you looking at a given time frame, maybe after 3 years, 5 years, look how it's been behaving year after year. And the most important thing is consistency, right? Avoid stocks of companies whose revenue spike. Maybe this year, they are on the positive. Next year, they're on the negative. Again on the negative, then they jump on the positive. If revenue is growing consistently year after year, that tells you the business is doing well. So that's a good candidate for you to consider buying because the revenue is on an upward trend, which most likely is going to continue, assuming it's been performing that way for the past 5 years, 6 years, 7 years, you name it. And then the third signal is that earnings per share is rising. Earning per share or EPS is simply a measure of how a company could appropriate their earnings to the outstanding shares. In case EPS is increasing, it basically means the company is creating more wealth for shareholders year after year because EPS is increasing. So in case you bump into a stock whose EPS is increasing, that could be a good signal that maybe that stock is a good candidate for you to buy because an upward trajectory in EPS says the company is creating more value to shareholders year in, year out. And of course, don't just look at one EPS and then make a deduction. Decide after looking at multiple years of EPS. Case in point, if EPS has been growing for the past, maybe let me say 5 years, that could be a good signal that actually the company is creating more and more value to shareholders. Therefore, their stock could be a good candidate for you to buy. And then the fourth signal, which you could consider, is that the company is generating positive cash flows, which of course are on the upward trajectory. Let's face it, guys. At the end of the day, if a company is not generating cash flows, it basically means it will be struggling to cater for its operating costs. And secondly, in case it has other obligations, like for example, debts, it will be struggling to pay debts because if they're not generating cash flows, how are they able to cater for their obligations? That is why you need to be looking at if a company is generating strong cash flows. In case it's generating strong cash flows, it indicates it's going to be able to cater for its operation in present times. And if the cash flow has been on an upward trajectory, also it's going to tell you that that particular company is most likely continue honoring its obligations, mostly relating to debts. Therefore, it won't get in trouble. And then the fifth thing you need to be looking at is check whether the debt levels are manageable. Guys, a good chunk of companies out here go down not because they're not making revenue, it's because they're overwhelmed by debt. That is why when you look at revenue, cash flows, and the size of the debt of a company, you can't be able to decide if a company's debt is manageable. Case in point, if a company's debt is run away, simply put, they most likely gonna struggle to pay their debt because their cash flows, their revenues can't be able to cater for the interest and the repayments which are required to make. How then do you expect that company to be able to generate a profit? Chances are they're gonna bump into the headache of generating a profit. That is why you need to also purpose to invest in those companies whose debt is manageable. Please note, I haven't put a specific figure on debt because manageability of debt really varies. Case in point, if a company is maybe making a net profit of 10 billion Kenya shillings, okay, and its debt is 2 billion Kenya shillings, that debt is manageable. Compared to a business, for example, which is making 1 billion Kenya shillings and its debt is 1.5 billion Kenya shilling, the second one is most likely going to struggle. That is why the manageability depends on context, okay? And then the sixth signal which you need to be looking at is checking for a high return on equity. Guys, return on equity or ROE is also an important ratio or measure when it comes to checking a company's health as you are deciding whether to buy or not. Because a high ROE simply means that a company is using shareholders' equity more efficiently. So you need to be also looking out for return on equity for you to be able to gauge how a company is utilizing shareholders' equity and even so how it's growing the shareholders' value over time. An important nuance to this is that don't just look at ROE of a company in isolation because yes, a trend could tell you something. But then again, there are typically best practices when it comes to ROE of specific sectors or specific industries. So also compare the ROE with ROEs in a given industry for you to really gauge and know how a company is faring before you decide whether to buy their stock or not. And then the seventh signal, and also very important, is that you need to check whether a stock is on an uptrend. What do I mean? This is an important point most for those investors who are really serious about investing. And I'm saying so because most investors out there sit at the benches timing the market. You can't time the market to perfection. That is why you need to be aiming for high highs and high lows. Case in point, if a stock is on an uptrend, right? Yes, there's moments where the stock dip a bit, but then again, today's high can become tomorrow's low. But then again, the stock continues rising over time. That stock could be a good candidate for you to purchase because yes, it is kind of like up and down on price, but it's constantly on the uptrend. That tells you that could be a good indication that most likely its performance in future is most likely going to continue following the same trend, as opposed to stock of a company which is fluctuating extremely. Maybe it's extremely high, then it goes to low lows. That is something which is quite fickle. But if you are seeing high highs and high lows, chances are that might be a good bet for you to invest in so that you're going to be banking on it continue to be on the uptrend over time. And then The eighth signal, and also a very strong one, is if company insiders are buying a given stock. Guys, out here we have moments, for example, where management of a company or even those top shareholders who are insiders in a given company do buy stocks of a given company. In case you see the insiders are buying a given stock, that could be a very good signal. And to give you even an example, using, for example, a relevant stock or shares in Kenya, case in point, for example, Cooperative Bank, we've seen even year in, year out, okay, the CEO of Cooperative purchasing stock or shares of Cooperative. In fact, the CEO of Cooperative Bank is one of the individual largest shareholders in Cooperative Bank. So think about it. If the boss of the company is purchasing and adding to their stocks to have their holding in billions and continue to increase year in, year out, that is a very positive signal to the outsider investors, because the insiders believe in the stock, or even most importantly, the insiders know something which is going to play towards ensuring a stock is appreciating in value over time. And then the ninth signal which you need to be looking at is dividends are growing over time. Dividends is basically cash which the company pays shareholders for them being part owners of a company. Come the end of the year, maybe the board of directors decides to share part of their profit with shareholders. So if a company is paying dividends, you need to look at two things. First of all, is it paying dividends outright? Fair enough. And secondly, look at the dividend yield and also dividend payout. Because the dividend payout ratio is going to tell you if the payout ratio is healthy or sustainable. And of course, the yield is going to tell you how the trend has been year in, year out. So look at all these for you to decide if to buy, because you could be wanting to buy a stock because you are banking on dividends or you are doing dividends investing. If that is the case, this is going to be an important measure for you, because it's going to tell you if a company has been paying dividends over the years, chances are they're going to continue paying dividends. More so if you look at the dividend yield and also the dividend payout ratio. Because if the ratio is sustainable, chances are they're going to continue paying out dividends, because a mature company with a sustainable dividend payout is at a good standing. And then the 10th thing which you need to look at as you are deciding if to buy is whether there is a clear growth catalyst. What do I mean? Growth catalysts out here in companies are things, for example, very clear competitive advantage, maybe distinct products. You could look, for example, at their product pipeline. See if in the roadmap they have products that are forthcoming. Maybe they have even changes they're going to implement in pricing, which is going to ensure they attract more and more customers. These are some of the catalysts which can tell you a company is serious about its growing, and also it's serious about really ramping up its revenue. So if there is a clear growth catalyst, and then you combine the growth catalyst with all the fundamentals relating to a given company, you can't decide if to buy or not. Because if there's a clear growth catalyst, the fundamentals are looking good, chances are that is a good stock to invest in, because most likely in future, you're going to see the share price appreciate, and even because of positive earnings, the company might be able to pay you dividends. Guys, those are 10 signals which you might look at for you to decide if you want to invest in any given stock or not. So don't just sit there saying you are not sure what to look at. I've just given you examples of things to look out so that you are able to make an informed decision. Please note, all this need to be implemented in context. That is why you need to do your own research before you jump on any particular investment decision. Cheers, guys, and I look forward to catching up with you in the next videos. Bye-bye and take care.